Right, let's touch base with our fundamental guest on the show, Dhananjay. Sinha from IDFC Securities joins us right now. Dhananjay, hi, good afternoon, and thank you for coming on board. Let's take it from where Jinesh Gopani's comment had left. It's about the market valuations. He seems to have a view that blue chips, even at this point of time, at the current levels, are looking very attractive. They're available for a bargain price. But you, on the other hand, are saying that markets overall are still looking overvalued. Can you tell us why?
So I think if you look at the earnings growth of Nifty companies, it's very, very modest. So if you look at financial year 2019, there has been a decline in the EPS, and if you look at 3-4 years, there has been the EPS has broadly remained flat. So if you consider the fact that the markets have actually gone to an all-time high, the multiples are trading at something like 28 to 29 times on a 12-monthly trailing basis, and then the consensus estimate for next year and the following year are very, very optimistic. So in the next 2 years, people believe that the earnings will grow by 50%. So on an average, over 25%. Around 25% each year. So that looks to be very, very optimistic given the context of what we have already delivered, and the potential for the economy to deliver such thing is very, very, very narrow. So given the context of the last 5 years earnings growth, last 10 years earnings growth has been in the region of 5 or 6%. So there's nothing that is happening over the next 2 years which can actually translate into 25% earnings growth each year. So I mean, this is a thing that we have seen every year, and there is a downgrade that happens. So essentially the market is driven by a good amount of liquidity flow in recent times because of the global flows and global yields actually being coming off. Those are, I mean, global yields have been nosediving across the world. So that is actually creating a sort of a multiple expansion. And it is true that there are select stocks where there are less stress, where the multiples have expanded. So clearly the outperformer. So if you look at the Nifty year to date, I think the performance has been roughly about 8.5%. So annualized basis about 16%. And within this, it's largely a few select stocks, such as in the sectors such as banking sector. You have IT sector, and some specific stocks in oil and gas, which is actually driving the market valuation. So clearly the market is very, very skewed and narrow from a performance standpoint. So I think that's broadly the thing about the market. If you look at the broader markets, I mean, the non-performance is there. Domestic flows hasn't been too good. Mutual funds have not really been investing as much in the mid-cap and small-cap stocks. Those have lost flavor over the last 1.5 years. And notwithstanding the recent rally in the market, people have not really being confident about investing in mid-cap. So I think it's a fairly truncated market. I mean, good stocks, wherever there is visibility, less of risk, I think that's where the multiple is disproportionately expanding. But I think that's broadly the case that we have seen in the recent times. From a fundamental standpoint, we think that, what we are saying is that, your consumption theme is actually slowed. And that's largely because there has been a cash crunch or liquidity crunch in the market, and also that government spending is actually slowed considerably given the context that tax flows have not been too great, and there has been a considerable amount of shortfall. And globally, because of the trade wars, there has been a decline in global trade activities as well. So that's impacting domestic economy as well. So I think these are the factors.
Right. Yeah. Then I just want to interject to understand about the deceleration that we've seen in the NBFC space and in the consumption space. These are two sectors which have been badly hit for the last many months now. How are you assessing this? Is this a good time to buy, or should one steer clear?
So I think we are staying clear of NBFC stocks. I mean, I have been my first cautious note on NBFC sector, housing finance companies in particular, came around October of 2017. So it's good long years. So I think what you see in the NBFC sector is something that was partly predicted by us, and I think it has actually turned out to be far more damaging than we initially thought. So clearly the liquidity crunch in the NBFC sector and the ALM mismatch that they had run, that has really hit them hard. But I think gradually what is happening is that the liquidity crunch is translating into credit risk, and hence that is a sort of a compounding of the problem there. At this juncture, I don't see a clear revival, very clear revival, unless there are regulatory measures that are taken and by the RBI or some interventions done by government, etc. I think this sector, especially the housing finance sector, will reel under pressure. My concern is that there are other NBFCs which are relating to real estate might actually start facing the cascading effect.
Okay.
So clearly within the NBFC space, one would favor consumer durables backed NBFCs versus real estate backed NBFCs.
Okay, Dhananjay, great chatting with you. Thank you so much for talking to us in detail about your view on the markets, on the various sectors and the developments and news flow that's coming in from around the world and within the country. Thank you so much.